Welcome to this briefing for transfer pricing professionals on the fundamental aspects of holistic intercompany transaction design. And the focus is going to be on how to integrate legal considerations and cross-functional considerations with transfer pricing analysis to create genuinely robust structures with substance. And so on the agenda, we'll talk about the intercompany transactions life cycle. Secondly, we'll bring in the cross-functional perspective. Thirdly, we'll do a brief recap on the legal aspects of transfer pricing. Fourthly, we'll look at a typical transfer pricing project and how legal considerations need to be factored in at the various stages of those projects. Finally, we'll leave you with some key takeaways. So let's start by looking at the intercompany transactions lifecycle. Historically, it's probably fair to say that the focus in transfer pricing was on filing. In other words, transfer pricing documentation in the form of master files and local files. And it's probably still true to say that a number of groups are still in that retrospective mode and do not have robust price setting policies and merely focus on after the event documentation. The problem with that and the weakness in that is, firstly, it clearly doesn't meet the governance standards which tax administrations now expect. And secondly, you can't rewrite history. So at the point where you are looking back on the previous financial year or earlier financial years, you can't change the legal fact pattern. You can't change the operational fact pattern. And really the best that you can do is create some kind of coherent explanation in terms of transfer pricing adjustments. The reality is that the task which corporates and their advisors face is how to plan intercompany transactions in advance for each financial year, in other words, the upcoming financial year, to implement those transactions, and that includes legal implementation, to operate those transactions, and that includes journal entries and real-time management of things like customs declarations and so on, but also real-time monitoring during the year of the margins of specific entities so that the need for post-year-end true-up and true downs are minimized. And then after the year is the preparation of statutory accounts, corporation tax returns, TP files, and so on, with a view to defending those positions in later years. So the clear sequence required is plan, implement, operate, file, and defend. And it's clear from the guidance issued by various tax administrations that this is the standard. So that includes from US, Germany, UK, Australia, and so on. So let's bring in the cross-functional perspective in terms of what are the different elements that mean that a group has a robust company transaction structure and group structure. And this is a combination of various different aspects. So just to give an obvious example, if you look at the bottom right-hand corner, so TP documentation and compliance, you could have the best and fullest TP master files and local files in the world. But if the group has weaknesses in its financial data, such that specific costs are not actually identified and recharged, then clearly there's going to be a significant exposure in terms of tax and transfer pricing. Similarly, looking at the left-hand side, so withholding taxes, for example, the group could have obtained the best advice in terms of withholding tax compliance and what that means in terms of the design of related party transactions, so which elements are in the nature of royalties, management fees, and so on. But if that advice on those positions have not been reflected in appropriate company agreements, then overall the system is failing. The perspective in the round is really that transfer pricing is one of a number of aspects that need to be appropriately controlled in order for the client to have a robust position. And just to explain, in the top left-hand corner, IP protection and DEMPI and alignment, when you consider what actually matters in terms of the valuation of a group, in other words, its enterprise value, intellectual property is likely to make up the major part of that value. So it's not simply about DEMPI analysis or transfer pricing analysis being correct. It's actually, is the group appropriately identifying and protecting its intellectual property in the right entities such that it can appropriately enforce and defend that in the outside world. So that means that you could often have a structure where a particular arrangement, such as a cost-sharing arrangement, is put in place. It may well make sense from a transfer pricing perspective, but if that is not actually integrated with the group's processes for actually protecting its IP, then the group may well have ended up worse off as a result. So let's do a very brief recap on the legal aspects of transfer pricing, including the role of intercompany agreements in transfer pricing analysis. So very briefly on the left-hand side, so we have the quote from the OECD transfer pricing guidelines saying, importantly, ex ante, in advance, contractual assumption of risk should provide clear evidence of commitment to assume risk prior to materialization. In other words, you can't reallocate risk after the event. Risk for transfer pricing purposes and in real world life, risk only has a meaning where there's uncertainty. There's no uncertainty in the past when risk outcomes are already known. And therefore, in order for a risk allocation to be robust, it needs to be reflected in genuinely contemporaneous agreements. And contemporaneous means in advance. Looking at the US, we have the IRS FAQs, which repeat the obvious, which is risk analysis in TP documentation should be consistent with intercompany agreements. In other words, it's the agreements come first. The risk analysis needs to explain why it's consistent with the contractual position and not vice versa. Then in the UK, we had the HMRC guidance reconfirming that contractual terms may have inherent value in and of themselves. So that's not saying that conduct is irrelevant. It will always be irrelevant. It's not saying that control of risk is irrelevant. What it's saying is that contractual terms are economically significant or can be economically significant and can change the economic nature of transactions. And that aligns with the case studies in the OECD TPG, showing that the presence or absence of a single term can actually change the economic nature of a transaction. Then we have in Germany, so this is an extract from the 2023 update of the German guidance, the transfer pricing guidelines. And this is confirming the strict ex ante approach that applies in countries like Germany. And this is saying that the relevant point of time for applying the arm's length principle, it's not the point in time when the transaction happens. It's actually the point when the relevant agreement was concluded. This aligns with how transactions are priced in the real world. So when you book your holiday, you lock in the price, you lock in the deal at the point where you make the booking, and it doesn't matter when in the future you're actually going to travel. Similarly for insurance contracts, you lock in the arrangement as at the point in time when you pay the premium, and it doesn't actually matter when during the period of coverage the accident happens. So this is just a reconfirmation of the fact that economic analysis, transfer pricing analysis can't happen in a vacuum. It needs to consider the totality of the fact pattern, and that includes the legal fact pattern. Then looking on the right-hand side, so here we have a paraphrasing of the 6 steps for delineating the actual transaction with respect to risk. And we still see transfer pricing reports, documentation, which jumps straight to step 6. In other words, goes straight into pricing, benchmarking, without going through the earlier steps, which is what actually are the significant risks here. How are those risks actually allocated from a contractual perspective? Then looking at functional analysis, looking at consistency between contracts and conduct and control of risk. This is clear. The issue is what we have in the OECD transfer pricing guidelines is really a rule book for after the events transfer pricing analysis of transactions. It's not a rule book for designing transactions in advance, which, as we've already discussed, is the real task at hand here. So that leads us on to what is an appropriate order of events and process. So what we've tried to break down here is a typical transfer pricing project, maybe creating new TP policies, maybe benchmarking specific transactions, or maybe refreshing policies. And the color coding here is purple indicating legal or quasi-legal aspects, which are typically handled by transfer pricing teams. Blue being legal aspects which are handled by LCN or other lawyers, so because it needs that skill set. And then orange, importantly, we've got cross-functional issues here. And we're looking here at 4 major steps, really. Step 1 being understanding the business. Step 2 being tentative analysis in terms of breaking down the individual structures and having a preliminary choice of TP method and structure for each transaction. Step 3 being the deeper dive, which is the benchmarking and economic analysis. And then step 4 being finalizing, documenting, implementing. And really the key point here is making sure that the process is robust and does not skip steps, and really taking on board the holistic requirement and the governance requirement, which is to transition corporates to the proper process of planning, implementing, operating, documenting, and then defending. So looking at the purple aspects of step 1, so in the next 2 slides, we've got a deeper dive on what exactly are you looking at as TP advisors in terms of that. The blue aspects on the left, legal rights and intangibles. So you will come across cases where actually, in order to analyze the transactions at a preliminary basis, you do actually need a deeper dive. For example, understanding what exactly are the legal rights in intangibles, because without that, you can't properly undertake an MP analysis. Step 2, tentative transaction structure and TP method. A critical point here is the first bullet point, so the orange highlighting. In other words, it is critical at that stage to identify all the stakeholders in transaction design, because there's no point in documenting or designing a transaction from a TP perspective. It conflicts with the regulatory environment within which the group works, or it conflicts with its tariffs strategies or withholding tax considerations. So identifying who needs to have a seat at the table in terms of transaction design is critical. Looking at the purple highlights in step 2, so you as transfer pricing advisors, you will need to identify for each proposed transaction type, what is the assumption as regards structure and headline terms. In other words, is it a cost plus transaction? In which case, what is the nature of the services, whatever, who are the parties, what's the assumptions as regards IP ownership and so on. And crucially, as part of that, you will need to have identified existing intercompany agreements, and from a headline perspective, any potential conflict between the proposed structure and what the existing intercompany agreements say. So you'll need to identify that and either satisfy yourself that there is no conflict, or if there is a conflict, then you may need help in resolving that conflict. And I would say that looking at the blue highlighting, for more complex transaction types, such as cost sharing arrangements or cost contribution arrangements, profit splits, cash pools, and so on, it's probably going to be appropriate to prepare a draft intercompany agreement at that stage, because often it's only through having an agreement to focus on that you can properly take into account the relevant factors for economic analysis later on, and also you can start to think about the interests of different stakeholders. Looking at step 3 and the deeper dive in terms of benchmarking and economic analysis, just wanted to highlight the purple aspect here. So where applicable, review the terms of comparable agreements. So this means where, as part of your benchmarking, you actually have access to third-party agreements, whether they are internal CUPs or whether there are agreements available from a database, you're going to have to actually review the terms of those agreements to assess whether there are any features that impact on comparability. So to give an example, supposing you have an intra-group set of transactions, which is in effect a quasi-franchising, intra-group franchising arrangement, and supposing you have access to third-party franchise agreements. So one of the things that you'll need to understand is it's not just about looking at what the royalty rate is on those third-party franchise arrangements. It's also looking to see what is included and what is not included in that royalty fee. For example, in third-party franchise arrangements, it's common for the franchisor to make additional charges, such as for training or something, and that may be on top of the franchise fee, or it may be included within that. And obviously, where that's applicable, you'll need to be aware of that distinction, and that will provide you with context for any adjustments. So moving on to step 4, which is finalizing the transfer pricing analysis, documenting the TP analysis, and actually implementing the arrangements. So at that stage, if you haven't already arranged for agreements to be created, at that stage, that's when you'll need to do that. And that would typically be carried out by lawyers. You as TP advisors will want and need to review those draft agreements for consistency with the TP analysis. You or the client will need to make sure, looking at the orange highlighting, that wider stakeholder input is taken into account before agreements are finalized. And also, in terms of the blue at the bottom, whether this is carried out by lawyers such as us or by you and your team, it's important to create the correct paper trail so that it is not just tax told us to do it or our TP advisors told us to do it, even worse. It's that directors are properly briefed on the context. So what is it they're being asked to approve, why they're being asked to approve it, why the structure was chosen as it was, what the business rationale for that is, and who they can go to ask any question. And then, of course, the agreements actually need to be implemented. So that may just mean signing and dating the agreement, but there may also be additional filings required depending on the subject matter. For example, filings with local IP registries and so on. As a deeper dive into the stage 1 or step 1 considerations, this is the first of 2 slides, really looking at what is it that you as TP advisors need to make sure that you've captured and identified, so legal issues which are economically relevant. And I'm just going to go through them relatively quickly. So the first is, do you have any regulated entities within the group? So financial services or pharmaceuticals or whatever. And the reason is obviously where that kind of consideration applies, it is mission critical, it is central to functional analysis and risk control. And you need to make sure that whatever you're saying in the TP analysis does not contradict and undermine the group's regulatory approval. Second point, supplier contracts, customer contracts, and contracting entities. So you might be surprised, but a number of groups are not actually clear or up to date in terms of which entities actually contract with the outside world. So you need to be crystal clear on that because it does impact on which entities bear risks if those risks are not effectively offloaded onto other entities. Next point, where you're dealing with the group which involves physical goods, understanding the chain of title to goods, so all the way from raw materials entering the group structure to contract manufacturers and so on, and the flow of title to third-party buyers. How does that chain of title actually work? And how does the physical flow of goods and raw materials actually work? Historic M&A transactions are essential to identify for 2 main reasons. Firstly, they may indicate fragmented intangibles, and that needs to be properly understood and identified, especially if historic M&A transactions have not been properly integrated. Secondly, for recent M&A transactions, the terms of the M&A agreements may actually constitute a constraint on how the target business can be operated. So, for example, if a group has acquired another entity or subgroup on an earn-out basis, during that earn-out period, there may actually be restrictions under the share purchase agreement as to how the purchasing group can operate that entity and specifically on related party transactions. So you need to understand that. Then at the bottom of this slide, JVs and minority shareholdings clearly need to be understood, and they're typically associated with actual hard-edged legal constraints on the terms of related party transactions. Moving on, third-party loan facilities, cross-guarantees, and security, extremely common. Fundamental to understand risk allocation, not just in terms of intergroup financial transactions, but because cross guarantees mean that individual entities may be bearing risks, and therefore that will affect your analysis of the economic position of different entities from the perspective of those other transactions. Entities with negative reserves, negative net assets, or other solvency issues. So these are absolutely a red flag. You need to make sure that you have properly identified them and they are assigned to slow down. The reason why you need to slow down is that where you have entities, individual legal entities, which are in that kind of position, there is a heightened risk of personal liability for non-arm's length or commercially irrational transactions. And the reason is, if any given entity does go into some kind of insolvency process, irrespective of the crew involved, it's likely to involve some kind of officer being appointed as insolvency practitioner or trustee in bankruptcy or equivalent officer. And that person is likely to have a statutory duty to investigate the conduct of directors in the period leading up to the insolvency. And that conduct would include the approval of intra-group transactions. And so it is critical that we collectively as advisors help to keep our clients safe and the directors of individual entities safe. Next on the list, significant litigation. Why is that relevant? Because if nothing else, it is a key indicator that there is risk there that somebody cared enough about to either litigate or defend, and therefore it's an indicator of perceived value. Next, intercompany agreements. So existing intercompany agreements we've already touched on, and the reason is that it's part of the fact pattern. And any material changes in the commercial terms will, at the very least, need to be explained and may need to be treated as a business restructuring. And finally, regulatory restrictions. So here, I'm not talking about specifically regulated entities. What I'm talking about is local legal restrictions such as royalty caps or management fee caps or interest rate caps, which apply in different countries. So an example would be the 3M blocked income TP case. So it's essential to understand that because clearly these kind of restrictions, where they apply, they are economically relevant. I'm going to leave you with 7 key takeaways from this session. The first is that TP professionals do have a unique opportunity because they routinely take a global perspective, a cross-border perspective. And that means that they're increasingly expected to act as trusted strategic advisors rather than just technical specialists. So there is an important opportunity to occupy the position as trusted advisor and take that global cross-functional holistic perspective. Second thing is many multinational groups actually need active, proactive support in establishing a robust governance lifecycle for intercompany transactions. In other words, transitioning away from the previous model, which is purely after the event TP documentation, which is limited in its effectiveness, to a proper governance process, which is plan, implements, operates, report, and defend. Third thing is, as we've seen, holistic cross-functional perspective is absolutely critical. And this is critical in order to design intercompany transactions which avoid unnecessary wasted costs, inefficiencies, and avoidable controversy. Fourth point is the starting point. It is the North Star in robust transaction design, and it should be the focus of communications. Fifth point is that economic analysis cannot be treated as a separate transfer pricing silo. It needs to be grounded in the legal and commercial fact pattern. In other words, establish the fact pattern and then analyze it from an economic perspective. And the fact pattern includes the proposed legal terms of the relevant intercompany transactions. Point number 6 is intercompany agreements serve the needs of multiple stakeholders. And so we've been through that, including withholding tax, corporation tax deductibility, regulatory compliance, and so on. So it's important to see them in that context. And the last step, which is hopefully obvious for everyone at this point, which is skipping steps does increase risk. So jumping straight to benchmarking reports is not a sustainable approach, and a disciplined, proper process, it really underpins sustainable and defensible outcomes. So that's all for this session. I hope you found it useful, and I look forward to next time. Thank you.